Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I am going to discuss new rules about NPS exits and withdrawals. Today I will discuss the recent changes in the National Pension System, exit and withdrawal rules. On 12 December 2025, the Pension Fund Regulatory and Development Authority PFRDA notified several major reforms aimed at making NPS more flexible and investor friendly. For many years, investors hesitated to adopt an NPS due to rigid exit conditions, mandatory annuity requirements, and limited withdrawal options. The revised framework directly addresses these long-standing concerns and significantly improves control on liquidity for subscribers. Let us understand the key changes and their implications for NPS investors. What if I tell you that NPS is no longer rigid? What if you could withdraw up to 80% of your money, stay invested till 85 years, take loans against NPS, and even exit early after 15 years? Yes, this is not a proposal. This is official law. On 12 December 2025, the Government of India, through PFRDA, notified major amendments to NPS exit and withdrawal rules. Today I will explain what exactly has changed, who benefits, and why NPS now deserves a second look. Key takeaways: withdraw up to 80% at retirement, only 20% mandatory annuity, 100% NPS withdrawal allowed for a small corpus, exit allowed before the age of 60, stay invested till the age of 85, simpler exit rules upon the death of the NPS subscriber, withdraw money up to 4 times before 60, partial withdrawal allowed post retirement with 3-year gap, clear exit on renunciation of citizenship, loan against NPS. For years, NPS had one big problem: lack of flexibility. At retirement, a large portion of money was forced into annuity, withdrawals were limited, and families struggled during emergencies or death cases. Many investors avoided NPS despite good returns, simply because exit rules were painful. The 2025 amendment directly fixes these issues. Biggest change: more control at retirement. Earlier, only 60% lump sum and 40% mandatory annuity. Now, under the new rules, you can withdraw up to 80% of your NPS corpus and only 20% annuity is compulsory. This applies to government, non-government and corporate subscribers. This single change removes the biggest fear around NPS. Full withdrawal for a small corpus. If your total NPS amount is up to rupees 8 lakh, then you can withdraw 100% lump sum. rupees 8 lakh to rupees 12 lakh. Withdraws rupees 6 lakh lump sum. Balance via annuity or phased withdrawal. Above rupees 12 lakh, 80% lump sum and plus 20% annuity. Earlier this full withdrawal limit was very small. Now it is realistic and practical. Exit before 60 is now allowed. Earlier existing NPS before 60 was extremely restrictive. Now, if you complete 15 years in NPS, you can exit even before age 60. Exit is allowed only when one condition is met: 15 years completed or age 60 is achieved or retirement from service. This gives career flexibility, especially for private sector professionals. Stay invested till age 85. Earlier exit age limit is 75 years, now extended to 85 years. Why this matters? Many retirees don't need money immediately. NPS can now be used for long-term compounding, helpful for estate planning, You can also defer annuity or lump sum and decide later. Simplified rules on death of subscriber. This is a huge relief for families. If subscriber dies up to rupees 8 lakh, nominee can take 100% lump sum. Rupees 8 lakh to rupees 12 lakh, nominees can take 6 lakh lump sum plus balance phased or annuity. Above rupees 12 lakh, nominee can take 20% lump sum plus 80% annuity. For NPS Light and Savalamban, rules are also simplified. Clear tables are now officially notified. No confusion. Partial withdrawals before and after retirement. Before 60, earlier allowed only 3 times. Now allowed 4 partial withdrawals. Minimum 4-year gap between withdrawals. After 60, partial withdrawal allowed. 3-year gap. Maximum 25% of own contribution each time. This brings real life flexibility. Exist on renunciation of citizenship. If an NPS subscriber gives up Indian citizenship, NPS account can be closed and 100% lump sum withdrawal allowed and no annuity required. This is now clearly defined in law. Loan against NPS, a game changer. For the first time, NPS can be used as collateral and loans allowed from regulated financial institutions and limits are specified by PFRDA. This turns NPS from a locked product into a financial asset. Closing summary. Why this is important? Let's be honest. NPS has changed completely. Higher lump sum, lower annuity burden, early exit allowed, stay invested till 85 years of age, easier rules for families, loan facility introduced. These reforms make NPS one of the most flexible pension products in India today. Conclusion. The revised NPS exit and withdrawal rules mark a significant shift towards flexibility, transparency, and investor empowerment. With reduced annuity compulsion, higher lump sum withdrawals, extended investment age, and easier exit provisions, NPS has become far more attractive than before. These reforms make NPS a strong contender among long-term retirement planning instruments in India and encourage both existing and new investors to reconsider its role in their financial plans. Disclaimer. This video is for educational purposes only and is based on the PFRDA Gazette notification dated December 12, 2025. Rules are subject to change. Please consult official PFRDA notifications or a qualified financial advisor before making an investment or withdrawal decision. The author does not assume responsibility for actions taken based on this information. Thank you very much for your patience. Request for like, subscribe, and share.